Welcome back. In this video, we will discuss what is a cash flow statement. Are cash flows equal to net profits reported by the company? The type of cash flows. We will also look at a cash flow example reported by Alphabet Incorporated, which is Google. What is a cash flow statement? A cash flow statement is a statement reported by corporates in their filings along with the income statement and balance sheet. It is very important to understand the cash flow statement, but often overlooked by investors and analysts. While the income statement provides the detail of income and expenses and net profits earned during a particular time period, and balance sheet of the financial position of the company at a certain point in time, the cash flow statement shows how efficiently the company is managing its cash. How much of the cash came in the business during a time period and how much of it was expensed. Are cash flows equal to net profits reported by the company? The answer is no. This is because of difference in accounting methodology. Companies usually follow accrual accounting method to recognize revenues and expenses. In accrual accounting, revenue is recognized when it is earned and expenses are recognized when they are incurred. Earned revenue may not result in immediate cash inflows as product or services may be sold on credit. Similarly, expenses incurred may not result in immediate cash outflows as corporates usually pay for expenses to the vendors after a certain time period. Also, the income statement includes non-cash income and expenses like the depreciation expense, amortization, which does not form part of the cash flow statement. This is why net profits earned in a business is usually not equal to cash flows generated during that period. Therefore, it is important to analyze the cash flow statement to understand the cash position of the business. A cash flow statement is divided into three parts: cash flow from operating activities, cash flow from investing activities, and cash flows from financing activities. Let us understand each of them one by one. Cash flow from operating activities are the most important portion of the cash flow statement. It shows how much cash flows the company is able to generate from its business operations. This section explains the sources and uses of cash from day-to-day activities during a particular time period. Ongoing activities may include manufacturing and selling products or providing services to customers, payments for purchases, employee salaries, taxes, other operating expenses. Cash flow from operations can be prepared by two methods: direct method and indirect method. Both the methods give the same result. Direct method includes actual cash inflows and outflows from operations. This method is more intuitive compared to the indirect method, but it is a time-consuming process. It usually takes longer to prepare a cash flow from operating activities statement using a direct method. So companies usually follow indirect method for reporting cash flow from operating activities. A direct method of cash flow from operating activities includes cash sales, payment received from customers, payments made to vendors, and payment for expenses, taxes, etc. The indirect method for preparing the cash flow from operating activities is easier compared to direct method. This method requires changing accrual accounting to cash basis. It is less time consuming and easy to prepare. Companies usually follow this method to prepare the cash flow from operating activities statement. The cash flow from operating statement using indirect method includes or starts with the net income. Then companies add non-cash expenses like depreciation and amortization, adjust for the non-operating activities like interest paid and interest received, and then adjust for the changes in the working capital. Summing up, all these give the cash flow from operating activities. Both the direct and indirect method gives the same result. Cash flow from investing activities shows the cash spent by the company in investment made for future growth. The investment could be in property, plant, or equipment, or acquisition of other business, or investment in securities of other companies. Cash flow from investing activities is generally negative as it is a cash outflow. A cash flow from investing activities includes the capex, the cash paid for acquisitions of other businesses, investment in securities, and sale of assets or business in cash. Cash flow from financing activity summarizes the transactions that involve raising and repayment of capital. This can be both through equity and borrowings. A cash flow from financing activity includes issuance of shares, loan taken, loan repaid, dividends paid to shareholders, and share buyback. At the bottom of the cash flow statement, we have the cash reconciliation. It shows the opening cash balance and ending cash balance. So it starts with the opening cash, then we add cash flow from operating activities, add or deduct cash flow from investing activities, cash flow from financing activities, and what is left is the cash balance at the end of the period. So this cash balance at the end of the period should reconcile with the cash reported by the company in its balance sheet. Now, let's look at an example of a cash flow statement reported by Google or Alphabet Incorporated. This is how the cash flow statement of Google looks for the year 2019. It has three parts: cash flow from operating activities, cash flow from investing activities, and cash flows from financing activities. Let us look each of them one by one. Here we have the cash flow from operating activities for Google. It starts with the net income reported by the company. Then we have adjustments of non-cash expenses like depreciation and amortization, which is added back to the net income because these do not result in actual cash outflows. Then we have adjustment for non-operating income and expenses. And subsequently, we have the changes in working capital. Making all these adjustments result in cash flow from operating activities. So this statement shows that Google has reported a cash flow from operating activities of 54.5 billion during 2019. Moving to the cash flow from investing activities, this is how it looks for Google. So here we have the purchases of property, plant and equipment, which is the growth capex for the company. Then we have the purchase and sale of investments. The cash acquisition done by the company of $2.5 billion. Net cash used in the investing activity is 29.5 billion. So the cash flow from investing activities is a negative 29.5 billion for Google in 2019. Moving to the cash flow from financing activities. So this is how it looks. So we have the payment made to the shareholders in the form of stock-based awards and repurchase of capital stock, repurchase of shares. Then we have issuance and repayment of debt to the lenders, and cash flow from financing activity is the sum of the two. So in 2019, Google's cash flow from financing activities is $23.2 billion. Now, looking at the cash reconciliation, so we have a net cash increase of $1.8 billion. This is the sum of the cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. When we add this to the opening cash balance, we get the closing cash balance for Google, which is 18.5 billion. Looking at the balance sheet, so we have the reported cash of 18.5 billion, which reconciles with the cash reported in the cash flow statement. Hope you enjoyed this session. If you find it useful, please like it and share it with your friends and colleagues. Thank you.